Welcome to this lesson. In this video, we are going to learn about common size financial statement. It means it's a way of analyzing financial statement or data by expressing each line item as a percentage of a base figure. For example, in this statement of profit or loss, we express each item as a percentage of the revenue. And then for the sales, for the financial position, we express each item as a percentage of the total asset. So let's prepare on this side. Common size income statement or statement of profit or loss. So for A and B, for A and B, company A and B. So we start with this one. You can put this side. So we express this line. This is the sales. You can do it on this side, equals to. So that's the revenue. You can express still on the revenue. And then we can express this as a percentage. Actually, the whole of this area as a percentage. Then for the cost of sales, still we express it as sales or the revenue, and then we lock this. We can lock this the base, which is the revenue, and then can autofill on the other lines. Then for this one also, for company B, we express also each line in terms of the revenue or the sales, and then we lock that cell so that we autofill the remaining. So you can see. Then for the statement of profit and loss, you can also do the same. Say common size financial position. You can put them here. That's for both company A and B. Then you can express this one equals to. So each item for the balance sheet we express over the total asset, and then we can lock that formula. We can lock that cell so that. Sorry, there's an error. Is the error? Let's do it again. Equals to this over the total asset item as a percentage. So it's 29%, and then it said we look that cell B. Then we can drag that one. We can autofill all up to where? Yes, up to the total liabilities and equities. Then we can do the same for the second company. So each item we expressed as the percentage of the total asset. Then we can change that to percentage. Then we autofill yes up to that point. Then yes, then we can do the analysis now, so that we can advise the directors of company C on which company to take over. Is it company A or B, based on the common size analysis we have done. So for example, for now we can see, let's say the profit of the year. Company A has profit of 14%, company B has a profit of 8%. So in terms of profit, you can see company A is more profitable. Then also the profit before tax, you can still see 18, then 10. So company A still has more profit before tax. Then also the operating profit, company A has 19%, company B has 12. So company A is still higher. Then for the gross profit, you can see still company A has 24, company B has 18. Still company A has a higher profit. So in terms of profitability, we can say company A is more profitable than company B. So in terms of profitability, company A is better. Then for the statement of financial position, you can see in terms of non-current asset, company A has 50% non-current asset, then company B has 54% non-current asset. But if you check keenly, you find that out of the 54%, you can see 25% of company B's non-current asset is right of use asset. Right of use means is the asset that you don't own but you have the right to use. So still, it's not a real current non-current asset. So meaning we only have 26% of the non-current asset. So in that regard, still A has a higher non-current asset than B. Then for the inventory, you can see 17, 18, slightly higher. Then trade receivable 22, 27. But when you check the bank, company A has 11%, then B has 1%. So in terms of liquidity, company A has a higher liquidity than B, because it's 11% and 1%. Then these ones are really irrelevant. Yes, this one. Yes. So then in terms of the equity, company A has more equity owned than B. Then can still remove this. It's not important. Then in terms of lease liability, you can see in terms of non-current liabilities, lease liability, company A has 0, company B has 22. Then company A has 47% of loan, then 26%. So in terms of liability, in terms of current liability, find that Company A has these two, so 22 plus 26, 48, 47. So company B has more liabilities. So the more the liability, the riskier the company is. So in terms of liability, company A is still better. Then you can see trade receivable payable, still company A is 13, 11, slightly company B is less. Then lease liability 4, 0, 4, current tax 8 and 11. So based on this, we advise the directors of company C to take over company B because company A, because we have seen in terms of profitability, company A is more profitable. In terms of non-current asset, company A has more asset. In terms of liquidity, company A has 11% in the bank, 1%. It has more liquidity. In terms of liability, company A has a less liability. So it's less riskier to take over company A than B. So that's the advice we give to the directors of company C. Yes, that is it. Please subscribe for more BDA lessons, and thank you.